Hey there, everybody. Thomas Wood with Basecamp Trading. It is Friday, June 2nd, and we're going to take a look at gold here. And I want to talk about a couple of things that happened with gold. Now, obviously, today we had non-farm payroll, first Friday of the month. You get your unemployment numbers. Gold ended up spiking, bonds spiked a bit, indices up a little bit, euros up a bit, etc. But what I want to talk about is what happened with gold leading into the breakout that we had, and what the breakout would have been if you were trading it. So we've talked about previously paying attention to when a market breaks through support or resistance and how it behaves immediately after breaking that support or resistance, and watching for what we call a run on the stops. Well, if you look down here last night, we had just a textbook run on the stops. It broke through the support from the two pivot lows at 1261.8, immediately reversed and closed up in a hammer. Okay, that right there means run the stops. There's a video in this series on YouTube here from a couple weeks back. I explained how you determine when a market's running stops and where turning points are, that type of thing. But that's a big clue to where that market is heading, because it's telling you there's unwillingness to sell down below that support, and it turns around and started climbing back up. At the same time, we started to pick up some momentum. Now, what we did here is we changed trend. We went low, lower high, lower low. So it changes trend to a downtrend. The very first thing you do when you change trend is you draw your line in the sand. Your line in the sand is the trend line connecting the two pivot highs, or if it changed to an uptrend, trend line connecting two pivot lows. And what that line in the sand does is, as long as we stay below that, we should continue with a downtrend. If we break through it, however, we look for a snap reaction for it to resume the up move. Okay, so in this case, we broke through it right after non-farm payroll, and snap, we accelerated straight back up. So it's a great trade opportunity. Now, yesterday we talked about, or the day before, we talked about trendline breaks and the resistance that occurs directly after them. Here's a good example of one where you do not need to wait until the pivot high is broken, because the trendline break occurred at 1268. The pivot high was at 1271.5. So that's $350 a contract worth of a move just between the break point and where the first resistance is. So you can wait, and you can go ahead and trade the break instead of waiting for the resistance break from the pivot high. And that will help you get that extra additional profit. Plus, even a trade between the trendline break and the resistance break is still a nice little intraday scalp. So this is just another example of when you do not need to wait for the pivot high to be broken after trendline break. Okay, so a couple of things here that we're talking about, and main points from today. Pay attention once more to when you're running support and resistance. Watch for those run the stops. 2, once your trend reverses, draw your line in the sand. If that line in the sand is broken, look for the resumption of the original move. 3, if there is a pretty good distance between where the trendline break is and the pivot high, you're still in the clear to take the trendline break as opposed to waiting for the pivot high break. Alrighty, that's all I have for you guys for today. I will see you in the trading room bright and early Monday morning. Have a great weekend. Until next time, don't forget to subscribe, and happy trading.